Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. This morning, let's get to the three things that you need to know today.
First up, U.S. stock futures falling this morning after President Trump's tariff U-turn, sparking a massive market reversal. Stocks closed out Wednesday's trading session with the biggest surge since 2020. The S&P climbing 9% on the day as the tech-heavy NASDAQ 100 logged its biggest gain since October 2008. The Dow rising by nearly 3,000 points. Plus, the bond market rout easing from its sell-off, which the president said he was looking at when he made his decision to pause tariffs.
The tariff pause for dozens of trading partners will last for 90 days. The European Union, though, delaying its retaliatory tariffs as it focuses on trade talks with the U.S. amid the pause. But notably, not exempt, China. They're going to now see trade levies of 125%. Meanwhile, China's 84% tariff on U.S. goods takes effect today as the U.S.-China trade war heats up.
And the March inflation report coming out this morning. CPI data last month showing inflation dropped month over month, with Wall Street actually expecting a gain. Core CPI also coming in cooler than expected, but the relief may be short-lived as investors are expecting widespread tariffs to contribute to price pressures going forward. Half hour into your market open, let's get you a check on the major averages. Your S&P 500 futures down about 1.8%. Your tech-heavy NASDAQ taking the major hit this morning, down about 2.4%. The big question we're going to be asking our guests this morning, why didn't the buying continue if there was a fundamental change in the market mood? That is something we will cover throughout our programming. But let's get a check on the bond market continuing to be my Roman Empire of the week here. You've got the front end of the curve really coming in here, and that's the end that's going to be a little bit more rate sensitive. So was that CPI print showing a cooler inflation backdrop, giving investors the idea that maybe the Fed will have more leeway to cut moving forward? Obviously, that inflation print did not include details and the impact of all of these tariffs, especially that 125% tariff on China. So could that lead to more inflation going forward? And then could we see that pushing up yields again, as we had seen prior to that announcement from the president yesterday?
A brief bout of relief has faded back into panic for investors after Trump's tariff pause Wednesday. The NASDAQ and the S&P 500 had their best days since 2001 and 2008, respectively. But the trade war is far from over as tensions between the U.S. and China ratchet up. What does that mean for the market in the near term? Brent Schutte, Northwestern Mutual Wealth Management Company CIO, joins us here this morning. What a time to be alive, Brent. Can you help us just break down the thesis around yesterday's rebound from a self-induced near bear market scratch, and now ultimately what the trade looks like from here for investors?
Unfortunately, I think more volatility, as you mentioned in your opening. Look, we didn't dramatically alter the overall average tariff rate. We just shifted it towards China. And so if you think about that and think about the reality that tariffs are still out there, they're still on at the 10% level, they're on at the Chinese level, and they're on sectors, we still have tariffs higher than we have in the last 100 years, even after this quote unquote pause. And so to me, that means that there's more uncertainty as we negotiate and figure out what actually happens towards the end of the next 90 days. The second thing I would suggest is that I don't think the president's overall disdain for trade in general has changed. I just think he decided yesterday that he disliked the market's route just a bit less, as well as the bond market, which I think really caught his attention, and that's why he pulled back. And so overall, we're kind of still where we were. Certainly some of the tension has come off the boil, but there's still a lot of uncertainty out there. And to me, uncertainty means that people are more indecisive, CEOs and consumers alike, and that is the risk going forward in the next 90 days.
And there's also a risk that the big bounce yesterday was driven in part by short covering. There wasn't a lot of conviction behind it, and we're certainly seeing that play out this morning with stocks down again. If there wasn't that conviction in the market, then how do you suss out where we're heading from here?
Look, I mean, some of the biggest down days occur in bear markets, obviously, and some of the biggest up days occur in bear markets. And so to me, bottoming is more of a process, not usually a singular event. Yes, the VIX has spiked to high levels, but that is not always the coast all clear sign. Indeed, if I look at Friday's level on the VIX, which many people were touting at 45.3, if I go back and I think about a year forward, that typically does lead to higher returns. But just to give an example, the VIX hit 45.3 in September of 08. We still had 38.8% downside before you got to the other side where the rewards were a year out in the future. I'm not suggesting there's 38% downside. left in the markets, but there certainly is probably more back and forth. And that's where I think any investor listening needs to understand that there is still volatility ahead. That VIX is probably a good entry point for longer term investors, but certainly not the coast all clear with ups and downs and back and forth in the market. And I still would advise people to continue to diversify, because the place they continue to want to buy, the S&P 500, remains expensive. But there are cheap parts of the market, and that's where I think investors should focus on, who are more long-term oriented.
What are those parts of the market?
I sound like a broken record, but if you're thinking long-term, you focus on valuation. That's part of the problem about why the market's not bottoming. Even if you take a discounted PE on the S&P 500, it still looks relatively expensive. The good news is small and mid-cap stocks, yes, they are more economically sensitive, but they trade at 13 and 14 times forward earnings. If you think about international stocks, I do think you are going to see a weaker dollar in the future, much like today. That is a tailwind to international returns for U.S. investors. They trade at 13 times earnings. And so I think there's a different world in front of us, much different than what we've seen the past 5 years where U.S. stocks have dominated. And that's where I suggest that investors continue to diversify and not just buy what has won over the past couple of years.
Well, one thing that has won in the last couple of years, of course, is the Mag 7. If you had to be a buyer or a seller right now, which one would you rather be?
I'd be a diversifier. And so maybe that's the way of not answering the question. Look, I know people have concentrated there. I know that's where the beloved Mag 7 and those stocks are. But if you look historically, the same 7 names don't always dominate every single year. In fact, the top 10 names in the S&P 500 over longer periods of time, just buying those and then holding the next year has been a losing proposition. And so to me, I think the market has to broaden out no matter what happens in the next few months, next few quarters. And I think if we're sitting here 3 or 4 or 5 years from now, the Mag 7 will no longer be the Mag 7. There will be new leadership atop that, and the market cap weighted S&P will also have new leaders at the top. And so that's where I would advise people. It doesn't mean you can't own some of these. Just don't make them your sole holdings, which I'm afraid so many individual investors are doing.
Given that, can you talk to me about your thesis on the equal weight S&P? Because if you were in the equal weight S&P yesterday, you kind of have a bad day. So how do you make the investment thesis for that moving forward?
Look, the last 2 years, less than 30% of the names in the S&P 500 have beat the index. That is historically narrow. That happens at the end of economic cycles when the economy narrows. What has happened, at least in the last 50 years on the opposite side of that, is a broadening. This period reminds me of the late 1990s, where you had similar characteristics. You had the U.S. exceptionalism commentary. People only wanted to own tech stocks. They wanted to own the top 10 names in the S&P 500. And what happened over the next 7 years was that the S&P equal weight dramatically outperformed. That's where valuations are cheaper. They trade at 16 times forward earnings versus 20 for the market cap weighted. And that's where I think investors need to think about the future and think about the fact that valuation is not a near-term timing tool, but it does win longer-term discussions. And that's where I would focus on that over top of the market cap weighted. It doesn't mean that you shouldn't own some of that. Just don't make it your sole holding, because I do think you're going to see a broadening of the market on the other side of this whenever that occurs. And I think different names will lead us going forward, just like they have in the past.
Brent, you raise a point that actually gets me to my next question, which is a lot of the volatility and the price swings that we've seen recently get people into the mindset of trying to perfectly time the market and not miss out on some of the massive jumps or to the downside, legs lower. So with that in mind, what are the average time spans, the portfolio spans that you're seeing from clients that you're speaking with, and how they're positioning themselves even amid some of the turmoil?
You want to know the really great news? If you have a financial plan, it takes into account the fact that markets go up and down and that the economy has contractions and expansions. And your asset allocation takes that into account. You don't have to make big decisions on any one day. If you're one, not concentrated, there's not one huge decision because you own a lot of different things. And number two, if you have a long-term asset allocation and you stick to that long-term asset allocation, it means you're likely to get to your goals and objectives. And so to take some of the pressure off of, do you add now, do you not add now? I advise people to go back to that plan, to go back to their asset allocation and think about that longer term time horizon. Look, if you're buying stocks today, they're probably going to be good investments longer term. But I just think people have gotten so used to instant gratification where they buy every single dip because the Fed's going to rush in, because investors were underinvested towards stocks. That's not the case today. Americans have their highest allocation to equities they've had on record. The Fed is not going to rush in. It doesn't mean that stocks won't be a good long-term investment. It just means that there might be a little bit more time between you buying today and that instant or that gratification that you're going to have somewhere in the future.
Brent, all right, I'm going to fire up my T-shirt maker and get "I'm a diversifier" printed on that.
There you go. It's popular again.
It's popular again. Thanks so much. Good to see you,
Bringing
Brent.
it back.
Yeah, exactly. Switching gears here. President Trump defended his latest policy pivot, a 90-day pause on reciprocal tariffs, excluding China, to reporters on Wednesday. Take a listen.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible.
Just last week, Trump vowed on Truth Social, "My policies will never change." So what exactly prompted the president's policy U-turn? Joining us now, we've got Jason Furman, professor at practice at Harvard University and former CEA chairman under President Obama, alongside Terry Haynes, Pangea Policy founder. Great to have you both here with us. Let's just go into the policy for a hot second. And Terry, I want to get your reaction to the whipsaw reaction that we've seen, not only in the markets, but specifically from those who are even closest to the president right now and representing the U.S. on trade.
I got to say that I think the whipsaw is a little bit overstated if you go past it. You know, the policy concern still remains. The tariffs are more focused, and we're going to have a lot of negotiations in the next 90 days. So we may end up being back pretty much where we are today at some point, and that's probably one reason why futures are down a little bit. The staffing concern, the comms concern, I think is largely resolved. Bessent's clearly out front. That's a good thing. Gradualist, all the rest. This is never going to be all one thing or all the other thing. And Trump is very urgent about this, not just because he's got midterms coming up, but because he thinks this is a great opportunity to resolve a lot of the geopolitical issues and get China to the table in a way that actually lowers the geopolitical risk temperature. So that's a big thing. Meanwhile, what you're going to see is Trump pivoting very strongly towards getting the tax cuts done in that same 90-day period. So that's a very big deal also.
I'm going to come back to you on those tax cuts, Terry. But Jason, I want to bring you into the conversation because you had a great post about how these tariffs on China do in fact outweigh the totality of the reciprocal tariffs on those other 70 plus countries. So where does that leave us in terms of the impact of this policy?
Yeah, yesterday's announcement was a tariff shift, not a tariff reduction. And that's going to dawn on people. Businesses are waking up thinking about that. I've heard from some. You're going to start to see it in the data going forward. Just to step back, on the campaign, President Trump said 10% across the board tariff plus 60% on China. We are now above that when you take into account the sectoral tariffs and, of course, China above 100% tariff. So by any way of looking and thinking about tariffs, the United States is now an extremely high tariff country, and you're just going to start to see that in the data in the coming months. The good news yesterday was the president did show that he cares about the bond market, did show that he cares about the views of the Treasury Secretary. I hope that continues, but anything is possible with his decisions.
Let's continue that, Jason. I want to take a listen to what President Trump had to say about the bond market.
Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy.
Yields on the 10-year were obviously soaring earlier this week, and the president referenced that. But now we are seeing yields coming in just a bit. Terry, did the bond market actually move the needle for the president, or did Treasury Secretary Scott Bessent convince the president that the move in the bond market was significant?
Well, I think it's probably a little bit of both. The bond market certainly was a concern, number one, and number two, we know that Bessent's been telling Trump that he needs to make sure that his communications are much clearer with markets generally. So I imagine it was a little bit of both, yeah. But they're going to continue on as Jason says, and I agree with his view that it's a shift, not some sort of volte-face.
Jason, want to get your reaction to the same?
Yeah, I mean, we don't know why the president made his decision. Probably the scariest thing I read was in one of the Wall Street Journal inside stories, which said he knew it would be a recession, but he wanted to prevent a depression. And I guess that's good news that he wanted to prevent a depression. but we are making a choice to have the unemployment rate go up, the inflation rate go up. All of this is going to put the Fed in the box. This morning's CPI print takes a little bit of the pressure off. It's going to let the Fed be a little bit more focused on combating rising unemployment. But we're still early days in the macroeconomic effects of both the tariffs and their uncertainty they've unleashed.
And so with that in mind, we've talked about who internally the president might be listening to, but externally, it seems like he's paying attention to what those on Wall Street might be saying, regardless of whether or not Scott Bessent is saying that Wall Street's had its time, it's time for Main Street. But clearly, when you have this many economists and CEOs talking about unprecedented uncertainty, that's got to grab the ear of the president to the extent that he doesn't want to see a bear market and doesn't want to have a recession on his hands, even though he's acknowledged that there will be some near-term pain.
Yeah, look, I mean, if you compare to what we thought about him 24 hours ago, he is more responsive to markets than many of us feared. If you compare to what we thought, to a couple months ago, he is still much less responsive to markets than we thought. So all of this is a matter of framing. It was like dialed way, way up, and now it's been dialed back a little bit. And overall, though, this is a man who is still presiding over a stock market that's down quite a lot since his inauguration and doesn't seem to be making any fundamental set of changes to respond to that fact.
Terry, I want to end with you on tax cuts. Senator Thune saying that the Senate is aligned with the House, that many senators do want to see more than $1.5 trillion in tax cuts. How likely do you think it is that we could get those policy sweeteners that the stock market has been looking for sooner rather than later?
My guess is this, Madison. Politically, I think it's almost impossible. You look at things like Medicaid; that's a third rail for an awful lot of Republicans, and what they're more focused on is the biggest tax cuts possible using a current policy baseline, which sounds wonky, but what it means is that they get to vastly pump up the amount of tax cuts without having the pain on the funding cut side. Number one. Number two, neither Democrats nor Republicans have any appetite for this. Republicans' big view is last year was that they'd cut 1% from the 30% of discretionary spending. So these are by and large not Braveheart types who want to take an axe to anything. And thirdly, they all want to get reelected. And what's going to end up happening here is Trump's going to drop the political hammer on them and force them into the same box that the Senate's in right now.
Jason, just want to get your own, and actually, you know what, Terry, let me put this to you first, and then Jason, I'll get your reaction. Terry, what does the next 90 days look like, realistically?
Well, realistically, the next 90 days looks like continued negotiations, probably some wins, continued jawing with China, maybe without result. Other geopolitical hotspots continue on. Doubtful we'll have some sort of Ukraine deal that's acceptable to everybody. Doubt that the Middle East is going to go away, and those are both, and doubt that we have a deal with Iran, which is these are all geopolitical flashpoints that China plays massively into. So I think it's going to be very unsettled for markets, and it said so, frankly, before the tariffs even kicked in.
Jason, just want to get your reaction. Are we due for an early summer surprise in the next 90 days?
We're going to get surprised over and over and over again in the next 90 days. What I don't know is if those are going to be happy surprises or sad surprises, but we're going to get more of it, and that volatility itself is a problem and is bad.
All right. Thank you both so much for breaking it down for us this morning, Jason and Terry. Really appreciate your insights. Coming up here on the Morning Brief, we'll count you down to the opening bell on Wall Street with stocks set to open in the red after that massive rally. All that and much more ahead on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. This morning, we're taking a look at some downgrades for automakers due to tariffs, retailers retreating after getting a big bounce after the tariff delay, and CarMax earnings. First up, let's talk a little UBS downgrade. General Motors is the subject of this one, from buy to neutral, and they've cut their price target for both GM and Tesla. Goldman Sachs, they downgraded Ford to neutral from buy and cut its price target. Both firms citing concerns about President Trump's 25% tariffs on autos and auto parts manufactured outside the U.S. Sector-specific tariffs were not included in the 90-day delay. UBS estimating that the annual cost burden for General Motors could reach $5 billion. Shares of all of these names pre-market moving lower by about 3% from what I could see on the screen a moment ago.
Yeah, it's interesting in terms of just how quickly these analysts have to react to policy coming out of the White House, because until the pause was announced from the president on all of these reciprocal tariffs, the 90-day pause, and then you had Secretary Howard Lutnick confirming later to reporters that these auto tariffs were still in place. There was a question for a little while there about what the change in tariff policy meant specifically for the automakers, but we do know now that that tariff on automakers still remains intact here, so no surprise to see some of these changes here. Also, we had UBS actually expecting GM to post a solid first quarter, forecasting Q1 2025 EPS about 9% above the consensus, but warning that guidance could be withdrawn due to macro and tariff-related uncertainty. And will we continue to see more and more guidance withdrawn? And what will that mean for investors trying to suss out company earnings? That is a key question for this quarter. But next up, let's talk about your retailers. You got Nike and Lululemon moving to the downside in pre-market trading this morning. Why are they moving to the downside? Because they've got a lot of exposure to China. Nike in particular, a very interesting one because of the degree of exposure. They had worked to move some of that exposure in their supply chains over to Vietnam, and then Vietnam is also hit with the tariff. So this is a great example of how you will potentially see some of these individual tariffs really mattering in terms of negotiations over these next 90 days. Obviously, the China tariff at 125% is going to be killer for some of these retailers, but we still don't know what's happening with the Vietnam tariff. So that could also potentially still be a headwind, even though the market yesterday acted like that 90-day pause was a great reprieve.
Retail is going to be massively struck by this. And one of the major things that you think about, even beyond some of the household names in the swoosh and, of course, the wishbone that is Lululemon. And, of course, Lululemon might be a little bit more happy that for some of what they produce in Canada, of course, that is where they are headquartered at and originate from. But, of course, the sourcing comes into mind and how some of those raw materials move throughout the manufacturing process for Lululemon, for Nike, even all the way down to the smallest players. The ones that you see a lot of people shopping from on Temu or on some of the random ones that pop into your social media feed, or the new companies that have figured out a way to source products, textiles from China, from Vietnam, and then be able to sell them into the U.S. market or other markets around the world for a considerable markup so that they can solidify their own margins. This is going to impact the entire retail industry. These two names just happen to be the publicly traded indicators that we can track in this near-term period of time.
Quote of the day, Claudia Sahm, T-shirts are the new eggs.
Exactly. Yes. Oh, my goodness. Finally here, shares of used car retail platform CarMax falling after posting an earnings mix. CarMax also pulled its long-term sales target goals of $33 billion annually, and then more than 2 million retail and wholesale vehicles. That was also part of it. The company cited, quote, potential impact of broader macro factors for its removal of a timeline to reach those goals. You're seeing shares down here pre-market by about 11% ahead of the opening bell.
And another example of a company axing their timeline for long-term growth forecast. The company did not give specific financial guidance for fiscal 2026, and they suspended the timeline for long-term growth targets that they had announced previously. And of course, they cited broader macro factors as part of that. They previously did have guidance in terms of sales moving to the upside in fiscal 2026 through 2030. Obviously, that is now coming into question because of the potential impact of these tariffs. We're going to have all your markets action ahead, so stick around for more. You're watching Morning Brief. We're We're counting you down to the opening bell on Wall Street, but let's do a check on global markets across the world here. You've got that huge spike up in U.S. equities, but we really saw this more broadly around the globe here. Obviously, the DAX over in Germany. You've got your London Stock Exchange moving to the upside here, and even China moving to the upside, despite the fact that we had that 125% tariff applied on China and that additional baseline 10% tariff as well. I do want to take a look at what we're seeing in the equity market as we hear the opening bell that is about to be ringing on Wall Street. You're taking a look at the New York Stock Exchange and the NASDAQ right now, but I do want to pull our attention over to the bond market here because we've continued to see fascinating moves in the bond market. They caught the president's eye. Your 10-year yield and the front end of the yield curve coming in just a bit here, but you've got your 30-year moving to the upside. Interesting to monitor that 30-year bond auction coming out later today. The 10-year auction was very successful earlier this week. Will we see that demand continuing? And lastly, of course, I'll give you a quick check on the major averages opening solidly in the red. You've got your NASDAQ down a little over 2.5%, your S&P 500 down about 2%. Let's get it over to Jared Blickery for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. Well, just first, some brief commentary on yesterday. That was NASDAQ's best day since 2001. But what's interesting is we rallied right back into, kind of bounced off of this area where we have some price memory. We had a lot of traders buying the dip in here, and those traders have a decision to make. Do they accept an almost break-even trade, in other words, get out of it, or do they just simply try to buy more? Do they, I don't know, flip to short? Anyway, there's a lot of decisions to be made when the markets enter one of these kinds of areas. And we see it for the S&P 500 and also the Dow. So it looks like markets are still kind of selling off ahead of this price area. So it tells me that shorts are still in control. And the volatility we've seen over the last few days has just absolutely been incredible. The VIX, by the way, yesterday fell the most ever. It was a record decline one day in the VIX. That's the VVIX. There we go. That is, in fact, what I was looking for. 3683 is where we are right now. That is still very elevated by historical standards. Tells you that there's still a lot of uncertainty, institutional uncertainty in the market. Real quickly on the 10-year and also the dollar. This is a year-to-date chart. 10-year coming down a little bit, 4 basis points, but that is not much in consideration of the 60 basis points rally it had over the prior 3 days. That was just simply astronomical in that speed. We also see the dollar that is lower now. You can see that's at the lows of the year, so that's something to keep an eye on. But I do want to move on to the to the sectors of the S&P 500, where we see staples, the only sector in the green. Tech, it was leading yesterday, one of the best ever days ever for the XLK ETF, and guess what? It is was leading to the downside. Now we see energy down just a little bit more. Let's check out the Mag 7 here. They added $1.8 trillion in market cap yesterday alone, but you wouldn't know that from looking at this one-day view. I'll just punch up a two-day view so you can see the outsized gains. So over the last 2 days, NVIDIA is still holding on to gains of 13%, Meta up 13 as well. And by the way, the biggest gains ever by Mag 7 stocks and probably all stocks occurred now yesterday. It was NVIDIA up about 440 billion and Apple up about 397. So some records there that we are seeing. Chinese stocks are interesting. We are seeing those jump for the second day in a row. They kind of followed on yesterday with that big risk-on rally, but we're also seeing some continuation today, which is interesting because we are seeing U.S. markets largely in the red. And I'll just leave that there. And then in futures, I got to talk about crude oil. Crude oil down 4%. It hit $55 per barrel yesterday, right on the nose. And this is a 5-day look. And you can see, if I put a 6-year chart on, we are at the lowest prices, and we hit them yesterday since 2021. So crude oil, a very important demand barometer for global economic health, and we're just not seeing that right now. So that's something that kind of speaks as to the deflationary side of what we're seeing. And by the way, CPI headline number came in negative month over month today. I will close on Bitcoin here. We are seeing Bitcoin up 5.5%. Had a nice day yesterday too. So let's take a look at the 2-day total, up 7.11%, 81,000. We might have had the flush in Bitcoin. We might have had the flush out of week longs that I was looking for, but we'll have to see. 70 to 72,000 remains my big support. So we're still about 10,000 above that. Send it back to you guys.
Jared, thanks so much. Appreciate it. It's time now for today's strategy session. Today, we're honing in on the defensive trade. The 10-year yield dropping today after seeing its biggest 3-day jump since 2001 amid Trump's growing trade war. So, Big question, is now time to buy into bonds, or are there more losses ahead? Joining us now, we've got Gene Goldman, Tariff Financial Group CIO. Great to have you here with us in studio. Let's just start with that question.
Sure.
What is the decision tree around whether or not to buy into bonds right now?
Sure. I think, first of all, thanks for having me back in your show. I think the key thing is, while we had a great day yesterday in the markets, we saw a phenomenal run, keep in mind, though, there's still a lot of uncertainties in terms of the trade war. Yes, one of the tail risks came off of tariffs, but we still have a lot of countries that we still need to negotiate with. We still have the fact that tariffs rise faster than they fall. We still have a lot of non-tariff barriers. So market volatility is going to be here for a while. A key way to mitigate against market volatility, in addition to liquid alternatives, will be treasuries. And we do think treasuries are still a good basis for defensive positioning. But with that said, though, inflation is picking up. So we do think yields are going to move somewhat higher despite their defensive characteristics. So I know it sounds like I'm saying on both sides of the equation, but clear, inflation is still going to rise and it's going to push higher. The one thing that changes the story, it's not our base case. We have a recession, the Fed comes in, cuts rates 4 or 5 times pretty quickly, inflation comes down. We just don't see that. Our base case is still a Fed 1 or maybe 2 rate cuts in 2025.
It feels like bond investors are coming in because they feel that the Fed is not going to. Like, there's bond vigilante activity potentially happening under the hood here. Does that play into how you think about advising people to own treasuries across the yield curve? Does that play into whether or not it's a safe asset for investors right now?
Yeah, we still think yields are going to move up a little bit, but we still think it's a very safe asset. We're very apprehensive of high yield. High yield spreads are widening, clearly signs of uncertainty. They're still well below long-term averages, but treasuries, again, offer that ballast in the portfolio. Simple example, you go back to 2008. One of the things that only did well, that mitigated against volatility, were treasuries. And with all this said, though, let's say the tariff issue gets settled, let's say, fingers crossed, but let's say it gets settled. The key thing to think about is that treasuries are pretty attractive. We're about 2% over inflation. We have a lot of retail buying of treasuries. We have a lot of foreign investors buying treasuries. Like 27% of treasuries are being bought by foreign investors. There's still significant demand. And if I'm going to get 2% over inflation on treasury yields on a 10-year, it's an opportunity.
And so with that in mind here, what side of, and you started to answer that question, the side of the duration that you should be comfortable owning treasuries at this point?
Sure. We've been incrementally raising duration in our portfolio. So let's say the Barclays Agg has a duration of about, let's just say 6. So a few years ago, we were down to about 3 or 4, and we've been incrementally raising it now. So now where we are right now, we're pretty close to 6, maybe like 5.5 in terms. So we're pretty close. We think duration, the ability to lock in that yield to get that coupon is an opportunity.
I want to move off of bonds and get some other picks from you.
Sure.
Talk to me about how you're viewing gold right now.
Gold. So gold's interesting. I think gold is such a defensive characteristic, but you also have to consider you need a weaker dollar to really benefit gold. I know gold is defensive.
We got that today.
Yeah, finally. Yeah. But keep in mind, though, countries that raise tariffs, usually their currency appreciates. And we haven't really seen it. We've seen a little mix back and forth. So gold, it's a good defensive characteristic, but I'm not really sold on gold. I think gold has run up too much, too fast, too quickly. So we're not really excited about gold. I do think if tariffs get settled a bit more, I would be more playing silver. Silver and gold are both 2 commodities, very precious metals. But as we all know, silver is everything. Silver is in this desk. Silver is everything. It has much more manufacturing capabilities. It's a good beta play if things get optimistic. And we are optimistic that stocks are going to be higher today by year end relative to where they are today. And
so with that in mind, does a 60-40 portfolio aptly position investors for what we've heard of as an unprecedented type of arena that we've entered into right now?
Everything's unprecedented. It's all new. This whole world. I mean, our base case coming into 2025 was a correction, some moderation in growth. The Fed a little bit on the sidelines more. This is very unprecedented right now. This is a binary trade. It's tariffs, yes, tariffs, no. So with that in mind, though, even a 60-40 portfolio still works, but I'd add a little bit stuff that's undervalued lately. Small caps, international, take advantage of that. And liquid alternatives. We are big believers in liquid alternatives, those things that zig when the rest of the markets are zagging. Because again, the markets are terrified. And again, markets want this volatility driver.
I'm gonna play a little game with you. I need rapid fire answers, like tight sentence.
I'm a big talker, though.
Okay. Give me a tight sentence on each of these sectors. Tech,
be very, very selective. Services over hardware.
AI then?
AI, we like AI as a feature. AI like electricity back in the 1890s. It's big, but the DeepSeek news worries me because now we're not all NASA. We don't need a big tool. We can get smaller tools. So be selective in tech, especially services over hardware.
Healthcare?
Healthcare, love healthcare. Healthcare, second highest expected earnings growth for 2025, defensive growth. I'm getting older. We're all getting older. You need it.
You've even got our floor director, Mike, laughing over here. Okay, utilities, and then I'm letting you go.
Utilities. If markets are very uncertain, utilities, yields are rising in utilities. If yields fall in treasuries, people are looking for income and safe income. Utilities are the best place to play.
I got a song for you, Gene, Forever Young. We're going to play it in the break.
That's us. That's us. All right, Gene, thank you so much.
Thank
really
you so much.
appreciate you.
Thank you.
You did a great job on that. Thank you so much. Coming up, Constellation Brands expecting a big hit from tariffs. Breaking down the outlook for the beer maker next on Morning Brief. Constellation Brands moving to the downside a bit today after topping fourth quarter expectations. Still, the Modelo owner issuing a weaker than expected outlook for fiscal 2026 as it expects to take a hit from tariffs. Joining us now, Bill Kirk, Roth Capital Partners Senior Research Analyst. Bill, thanks so much. Talk to me about your reaction and how you're thinking about the outlook for Constellation.
Sure. So we knew to expect a lot of news because they put the earnings release the day prior to the call, right? So the earnings release last night, call is going to be a little bit later this morning, and that's abnormal to them. So we expected, more news, more things to digest, and we got exactly that. We got the quarter, obviously, we got next year's guidance, we got wine divestitures, and we got a longer term algorithm change. So we got a lot of new information to go through. Obviously, the call is still to come, but specifically to the forward year guidance, a lot of that kind of below what people expected is primarily the wine divestitures. So simply, they are selling wine. 60% of their wine brands are going out the door. People did not have that modeled, obviously. People didn't know that was going to happen. So that is a big part of the kind of revision to the forward outlook. There's some consumer health revision to the forward outlook, and there's also some tariffs, and I'm sure we'll touch on it a bit more, but their tariff outlook, or at least their implied tariff outlook, is not as draconian as people feared. It looks like it's just on the aluminum packaging rather than maybe on the entire beer product.
Yeah, and so we were going to ask about that, and I'm glad you went into it because, this is not a week to drink if you hear the word tariffs. So with that being the free space on everybody's bingo card, how are you kind of looking through your own modeling to get a sense of what this might look like as a near-term and a potential long-term impact to the operations?
Sure. So there were scenarios out there where Constellation's beer would be considered aluminum. And that aluminum product tariff would apply to all the beer, not just the aluminum part of the beer, but all the beer. That was a potential scenario. And then there were scenarios in between where just the beer and aluminum cans would get a tariff and the glass bottles would not get a tariff. And then there's the scenario which is implied by their guidance where it's just the packaging material. And that would be the best case tariff scenario for Constellation. Just the aluminum cans, maybe it's about mid-teens % of their COGS, would get hit with a tariff. That is something that obviously not ideal, but much better than the entire beer being applied, getting a tariff applied to it. And so that is a manageable amount, right? If it's 15% of your goods up 25%, that's a couple points of inflation. Constellation can manage that. The beer industry can manage that. If that is indeed the case, which we'll get confirmation on the call, then tariffs aren't as bad as feared for Constellation.
How are you thinking, though, about the broader macro landscape and the fact that we could see a slowdown in the consumer and consumer spending overall, and whether or not that could be a negative read-through to Constellation or consumers keeping that Modelo regardless of the economy?
I think you're completely right. It already is. So Constellation reported its first negative beer volumes quarter since the 2009-ish part of the kind of the financial recession. So we're already seeing some of that. But where I stand on these consumer shocks is even if the environment doesn't improve, the consumer adjusts to the shock, right? So whatever the shock is, the consumer adjusts to that new environment and beer habits reform. Ultimately, during that recessionary period, beer had some of its best volume years in the last couple decades. And so we're in the shock period where, yes, habits are broken, but adjustments are made, consumers will get used to whatever the new environment is, and beer habits will reform. And so Constellation would benefit from that. Things would get better than what you see today and in this quarter. And on top of that, what we're hearing is they gained more shelf space at retailers this spring in the retailers' annual shelf space resets than they did even last year. So they have the extra shelf space. If that consumer gets a little bit better or gets a little bit more comfortable with whatever they're dealing with, that would be very good for Constellation.
I mean, doesn't it also come down to how we're seeing these shifts in younger generations compared to older generations, which could be, and it is something that we've spoken to Bill Newlands, who is the CEO of Constellation, about, and how they're modeling for that in their own plans for new brands where they might need to make acquisitions or where they may need to shift their drink and beverage strategy as a whole, knowing that the consumption trends are changing among younger consumers.
Yep. And that is a real headwind. It might not be a super new headwind, right? That's kind of a longer term, slower moving headwind, but it's a real headwind. Thankfully, their brands skew younger than the beer category as a whole. So they're doing something right with their marketing and their brands that appeal to those younger drinkers that the beer industry as a whole has had a difficult time with. Constellation's having a less difficult time with. I think when people are listing, the dire issues that face beer, they're maybe overemphasizing some of the impacts. Beer ended 2024 rather strong, a normal ending to 2024 for beer. It has subsequently gotten weaker, but the only things that have changed since the end of 2024, the younger drinkers, that's the same as the end of 2024. Cannabis, that's the same as 2024. Weight loss drugs, same as 2024. The only thing that's changed since the end of 2024 really is the administration change and maybe the policies related to the administration change and how that impacts consumer behavior. So if that's really the only delta in terms of what you're seeing in beer performance today versus the end of 2024, we think if the consumer adjusts to that environment, they come back. And all those headwinds are still there, but you go back to end of 2024 growth rates, which are just a slight decline from those headwinds, rather than the beginning of 2025, bigger declines that you've seen in beer.
And talk to me about wine before we let you go, Bill. Obviously, Constellation going through some of these wine divestitures through the likes of Woodbridge, getting that taken off the balance sheet. How does that impact the company moving forward?
It lets them focus on what they're best at. The wine takes resources, the wine takes marketing dollars, and their growth and their opportunities are more squarely around these Hispanic Mexican beer offerings. And so they divested a number of brands. It's about 60% of their wine portfolio is gone. It looks like they got about $900 million for it. Their entire wine and spirits division is on their balance sheet at $400 million. And so for 60%, they got $900 million. So it seems like a rather good deal for them. They're left focusing on their highest price premium wine products and brands. And that's where there is some growth in wine. And that is also something that maybe over time they continue to refine. But the focus is shifting predominantly to beer.
Bill, thanks so much for taking the time here with us today, breaking down these results from Constellation. And we're going to be listening to more from the brand a little bit later on today and tomorrow. Bill, appreciate the time.
Yep.
And as I mentioned, you can tune into Catalyst tomorrow at 10 a.m. Eastern for an interview with Constellation Brands CEO Bill Newlands. That coming your way at 10 a.m. Eastern Time. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. We're taking a look at U.S. Steel Corp, Prada, and Volkswagen. First up, U.S. Steel is falling after President Trump said that he does not want a Japanese company to buy the steel manufacturer. The president said, quote, "We love Japan, but U.S. Steel is a very special company." However, earlier in the week, Trump ordered the Committee on Foreign Investment in the U.S., or CFIUS, to take another look at the proposed acquisition of U.S. Steel by Japanese manufacturer Nippon Steel. The committee failed to reach consensus last year, leading President Biden to block the deal back in January. CFIUS now has a 45-day window to make a recommendation to President Trump.
Plus, Prada will acquire Versace from Capri Holdings for just under $1.4 billion, the companies say. The deal is expected to close in the second half of 2025, and the announcement comes after the Wall Street Journal reported the deal was at risk due to market volatility and tariff policy uncertainty. Capri owns other high-end brands such as Jimmy Choo and Michael Kors, and the sale of Versace will allow Capri to reduce debt and focus on its other brands as the luxury sector overall continues to struggle with weak demand.
Finally, Volkswagen shares trading in Germany are rising on President Trump's pause of many reciprocal tariffs. However, the company reported preliminary Q1 results, including a drop in earnings due to some one-off costs. Jefferies, which has a buy rating on the stock, is emphasizing these one-time costs, but also notes that tariff impacts aren't fully factored into the automaker's full-year forecast. Bernstein, with a market perform rating, is more cautious, saying they remain skeptical of Volkswagen's restructuring and says the company is still facing challenges. You could scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page.
That's going to do it. Join me in the next hour for more on Catalysts.